If you're on extended parental leave, some Canadian lenders will qualify your renewal using just 33% of your usual pay, capped at $403 a week in 2026. That single rule can quietly slash your borrowing power and trap you at a higher rate. I read the fine print so you don't have to. Stick around, because the last scenario shows the exact dollar cost of getting this wrong. The whole outcome hinges on one thing: how much of your income the lender is allowed to count. For a straight renewal with your current lender, most banks don't requalify your income at all. But the moment you try to switch or refinance, they can drop you to 60% of salary, or even to your EI benefit. Let's run 3 parents through it. Laura earns $85,000 a year, but she's on extended leave and hasn't given her lender an employer letter. Under extended EI benefits, she's paid 33% of earnings, capped at $437 a week in 2026 per Service Canada. With no documentation, her lender models her qualification on that EI income alone. Annualized, her EI works out to about $22,124. Set against her real $85,000 salary, that's a 73% collapse in the income the bank will recognize. At that level, switching lenders or increasing her mortgage is effectively off the table. On EI income alone, Laura can't pass the stress test for any competing lender. She's stuck taking whatever her current bank offers at renewal. No shopping, no leverage. That's the worst case starting point, and it's avoidable with one piece of paper. Now Laura provides some documentation, but her planned return is 15 months away, beyond the 12-month window most lenders require. Per reporting from the Globe and Mail and Tribe Financial, several institutions will count only 60% of her salary when the return date is that far out. 60% of $85,000 is $51,000. That's a $34,000 haircut versus her true salary, and it can be the difference between qualifying for a lower rate lender or being turned away. With $51,000 recognized, Laura might squeak into a switch, but it's tight and lender dependent. The single lever that fixes this is timing her return or her funding date, so the gap sits inside 12 months. Before I get to the last scenario, which puts a real dollar figure on all of this, subscribe if this is saving you money. In the third scenario, Laura secures a proper return-to-work letter confirming her permanent role, a guaranteed salary, and a return within 12 months. Per lender policy reported by Tribe Financial that lets the bank use 100% of her income. Now she can actually shop her renewal on a $480,000 balance. Staying put at 5.5% costs roughly $81,000 in interest over the next 5-year term. Switching to a competitor at 4.7% illustratively drops that to about $69,000. A modeled saving of around $12,000 plus $239 a month lower payments. With full income recognized, Laura qualifies for the better rate and pockets around $12,000 over 5 years, all from documentation, not luck. Over 2 term cycles, that gap can compound to roughly $28,000 in extra interest avoided, per modeling based on industry rate spreads. Line them up. EI-only view means no switch and 73% less income counted. The 60% haircut means a shaky $34,000 shortfall. Full documented income unlocks the better rate and roughly $12,000 saved per term. The mortgage, the balance, and the parent are identical. Only the paperwork changed. If your return is more than 12 months from funding and you have no employer letter, you're heading for scenario A or B. If you can secure a return-to-work letter and your T4, you're in scenario C. And remember, a straight renewal with your current lender usually skips income requalification entirely. The fix is often a single document requested before you ever talk rates. Next, I'm breaking down the mortgage stress test and exactly how lenders calculate what you qualify for. If you want to catch that, subscribe so you don't miss it.